The idea that over 10 years the nominal price of gold wouldn't triple or quadruple seems unlikely to me. The gold price ran 26-fold. I'm not suggesting, given the fact that gold has already run 20-fold.
Today we were at 4,700, more or
Sure.
less. We hit like
Yeah.
5,000. So you're saying the 15,000 gold in 10 years' time?
Yeah,
15,
absolutely.
20,000?
It's a fool's game to name both price and time. But I'm a fool, I'll try. I just need to say that I think that gold will mirror the decline in purchasing power of the US dollar, which is the nominal price of gold. The fact that our predominant financial export is gold is a tragedy. Not only is the dollar an untrustworthy medium of exchange, but U.S. Treasury securities are a lousy buy. To quote Doug Casey, the U.S. dollar is the worst currency in the world with the sole exception of all of the others. The United States is a better investment destination. In other words, Americans have more alternatives. There are parts of the world that don't spawn NVIDIAs or Facebooks or Apples. Strength in U.S. equities markets is drawing U.S. investors.
But let's bring it back to gold and central bank buying. That trend continues. Central banks remain one of the biggest forces in the gold market right now. According to the latest data from the World Gold Council, central banks bought roughly 244 tons of gold in the first quarter of this year alone. Countries like China, Poland, Turkey, Uzbekistan among the major buyers. China, no surprise there, has increased its gold reserves for 18 consecutive months. Officially, this is on the books, reporting holdings of more than 2,300 tons. Many believe that that real number is much, much, much higher than that. But Rick, at the same time, countries are not only buying gold, they're also increasingly bringing it home. India recently repatriated more than 100 tons of gold, dramatically increasing the share of its reserves stored domestically rather than with Western custodians. We know that France did a whole way to get back its gold from the United States while selling the gold here, then taking those funds at a handsome profit and buying gold again back in France, so effectively repatriating its gold in one way or another. What does this tell you, though? You're saying the dollar is still king, but central banks are aggressively accumulating gold, insisting on physical control over it, at least increasingly so. What is the message there then?
There are two messages that I can see, Michelle. The first is that the U.S. government shows no compunction against weaponizing the U.S. dollar. The utilization of the SWIFT banking system on a global basis to superimpose American will on other political cultures using the U.S. dollar as a weapon says lots about the administration's feelings for the sanctity of the US dollar.
Central banks are behaving like a currency crisis already started, even while financial media keeps calling the system stable. As Rick Rule points out here, official buyers added roughly 244 tons of gold in a single quarter, while simultaneously demanding physical custody inside their own borders. That is not diversification, it is counterparty distrust at the sovereign level. The real signal is not China buying gold. It is nations refusing to leave reserves under Western control anymore. Next, Rick Rule exposes why reserve repatriation quietly destroys confidence in the dollar-based trust system itself.
Secondly, of course, but making the same point, whether or not you agree with Russia's action in the Ukraine, the consequence of that is that the U.S. government stole $300 billion worth of Russian assets in the form of U.S. Treasury securities. The lesson that any foreign regime would learn is that if you have a policy dispute with the United States and the U.S. government can use either their own treasuries or, by extension, if they hold your gold hostage in that dispute, that they're going to do it, which is to say we've become a very unviable, untrustworthy custodian of other people's wealth. A second issue, I think, Michelle, is that the U.S. Treasury U.S. Treasuries themselves are much less good buys than they were some time ago. Specifically, and you and I talked about this before, the on-balance sheet liabilities of the U.S. government now exceed 39 trillion, closing in on 40 trillion. That number is going to grow by at least 2 trillion, but with the war, probably 2.5 trillion this year. More importantly, the off-balance sheet liabilities of the U.S. government, which is to say the unfunded promises around entitlements exceed $120 trillion. Those numbers are astonishing. Our deficit is over $2 trillion a year when our receipts are only $5 trillion a year. And I would suspect that that manifests itself in declining purchasing power of the US dollar. Specifically, I said this the last time we talked, I expect the US dollar to mirror its performance in the decade of the 70s. It lost, in an absolute sense, 75% of its purchasing power over 10 years, which is to say,
Washington says Treasuries remain the world's safest asset, yet foreign governments just watched $300 billion get frozen overnight. According to Rick Rule, the real damage was not financial. It was psychological, because reserve holders now understand access to dollars depends on political alignment. Add nearly $40 trillion in official debt, plus over $120 trillion in unfunded liabilities, and the risk-free narrative starts collapsing under its own arithmetic. Savers chasing nominal yields may discover too late that purchasing power erosion is the actual default mechanism. Next, Rick Rule unravels why foreign central banks are quietly abandoning long-duration dollar exposure altogether.
not only is the dollar an untrustworthy medium of exchange, but U.S. Treasury securities are a lousy buy. If you're getting paid 5% on a U.S. 10-year Treasury in a currency whose purchasing power is declining by 8 or 10% compounded, you're not making 5%. You're losing 4 or 5%. So this combination of the lousy credit characteristics of the underlying security and the weaponization of the instrument itself, the US dollar, I think is the reason why foreign central banks are increasingly, I think their phrase is disintermediating out of dollar-denominated securities and into gold. It's one of the reasons why I am too.
And yet you still think the outlook is that we're at least 10 years out from any major change in the global monetary system vis-a-vis the dollar.
Again, to quote Doug Casey, the US dollar is the worst currency in the world with the sole exception of all of the others. I'm not suggesting the US dollar is strong. I'm suggesting the others are more weak.
Cleanest shirt in the dirty laundry basket, as we've said before. Well, let's focus a little bit more on gold, because there has been another development happening in the gold market that, again, I don't think people fully appreciate, and that gold is becoming an increasingly global trade flow story. There was recent data from the US Census Bureau and the Bureau of Economic Analysis that shows that so-called non-monetary gold was actually the single largest US export in March of 2026. And this marked the 5th time in just the last 6 months that gold ranked as America's #1 export category. I mean, that is virtually unprecedented for the US. I mean, it's not aircraft.
Markets celebrated higher treasury yields, while ignoring that real returns may already be deeply negative after inflation. What Rick Rule is highlighting is that central banks are not chasing yield anymore. They are escaping currency debasement risk embedded inside sovereign debt markets. Gold becoming America's top export category 5 times in 6 months is not a healthy economic signal. It suggests strategic metal is leaving faster than confidence is returning. Retail investors still treating bonds as safe may be standing on the wrong side of a historic reserve transition. Next, Rick Rule reveals why gold is quietly re-entering global trade settlement flows.
It's not semiconductors, it's not pharmaceuticals, it's not any technology, gold. By February, I believe, according to the state of precious metals had overtaken traditional export giants like energy and aerospace. In March, US gold exports reportedly nearly double the value of oil exports and more than double the value of aircraft engine exports. Most of the gold is linked to Switzerland and the United Kingdom, But although ultimately it's believed to be making its way towards Asia, particularly China. And according to this trade data, Rick, the surge appears to be driven by several things happening simultaneously: safe haven demand, central bank repatriation, growing concerns about the dollar, increasingly the possibility that gold itself perhaps is re-emerging as a settlement asset in global trade flows. Also, Canada, we're seeing something similar happening in Canada. Canada just posted its first trade surplus in 6 months in March, and once again, gold played a major role there. Energy exports rose because of higher oil prices. Canada's metals exports surged 24% year over year, driven almost entirely by a nearly 38% spike in gold shipments. What do you make of this, Rick, that gold is leaving North America and at such a rate and going elsewhere? And why are we letting it leave?
I think the savings rate in the United States and Canada is disappointingly low. Really what we're doing is distorting a savings asset. Both countries are fortunate in that they're fairly major gold producers. So new supplies out of Nevada and new supplies out of the Abitibi in northern Canada are fairly accurate. But the fact that we aren't using it in North America as a savings product is disappointing to me as a North American.
When gold exports start overtaking oil and aerospace, something deeper than normal market demand is shifting underneath the system. Rick Rule's argument suggests global buyers increasingly view physical gold as a settlement asset, while North American investors keep chasing paper wealth through equities and debt markets. Canada's 38% surge in gold shipments shows strategic metal is flowing toward regions prioritizing reserve security over financial engineering. The danger for savers is not missing upside. It is holding assets denominated in currencies losing long-term trust. Next, Rick Rule exposes why Western complacency may become the biggest wealth destruction event of the decade.
Part of that can be explained away by the fact that the United States is a better investment destination. In other words, Americans have more alternatives. There are parts of the world that don't spawn NVIDIAs or Facebooks or Apples. And one thing that you're seeing is that the strength in U.S. equities markets is drawing U.S. investors into continuing to stay in things like the S&P 500 or the Triple Q at the expense of other asset classes, including gold. But a more pernicious answer, I think, is that North Americans are more complacent than they should be, and they are dishoarding a lot of savings assets. The traditional relationships between the amount of liquidity that Americans hold relative to their living expenses are high. The amount of consumer debt that we have in the United States is disappointingly high. The amount of government debt which we're willing to assume is too high, and some of the transfer of gold from North American markets to foreign markets definitely has to do with the increasing disfavor that U.S. Treasury securities are held in. But I think part of it, unfortunately, has to do with the complacency on the part of North Americans with regards to the amount of savings that they ought to have individually. You can tell I'm a disapproving old man around that. I believe that borrowing money on a credit card to sustain a lifestyle that's unsustainable is stupid. Just stupid. And I believe that not maintaining reasonable liquidity relative to the needs of your lifestyle, never mind the kind of liquidity that I maintain.
Consumer debt is exploding at the exact moment strategic gold is quietly leaving North America for stronger hands overseas. This is where Rick Rule's thesis shifts from macro theory into behavioral reality, because Americans are still chasing momentum stocks while sovereign buyers accumulate hard assets underneath the surface. Historically, late-cycle equity euphoria and collapsing savings discipline appear together near major monetary turning points. The real danger is not market volatility. It is households entering a purchasing power crisis with no liquidity buffer at all. Next, Rick Rule reveals why gold's long-term trajectory may simply mirror the dollar's slow destruction.
that will allow me speculative options in a market decline, I think that's very unhealthy. And I think the fact that our predominant financial export is gold is a tragedy.
Right. Having said all of that, what is your outlook for gold price-wise? Because I know you love this question.
Well, arithmetically, if I'm right, I expect gold over 10 years to maintain its nominal US dollar purchasing power. And I expect the purchasing power of the US dollar to decline by 75%. I'm not going to give you a gold price for June or July because I don't think in those terms. Mm-hmm. Besides which, you'd have me back on your show in 3 months and show the world how stupid I was.
Sooner than that, we'll be seeing you in July at your conference, but we'll get to that.
So I'm going to make a 10-year prediction, and I hope you're at my conference in 10 years, Michelle. If the U.S. dollar, as I believe, loses 75% of its purchasing power, the idea that over 10 years the nominal price of gold wouldn't triple or quadruple seems unlikely to me. We used the decade of the 70s as an analog. In the decade of the 70s, according to the Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power, and the gold price ran 26-fold. I'm not suggesting, given the fact that gold has already run 20-fold, almost, since the year 2000, that it runs 20-fold from here, but it wouldn't surprise me at all.
Most investors still think rising gold prices mean gold itself is becoming expensive, but the deeper story is currency deterioration. Rick Rule notes that if the dollar loses 75% of its purchasing power over the next decade, gold may simply reprice to reflect the monetary decline rather than create new real wealth. The comparison to the 1970s matters because policymakers today face even larger debt burdens with fewer credible policy exits available. Savers anchored to nominal returns could mistake inflationary survival for actual portfolio growth. Next, Rick Rule exposes why gold historically overshoots precisely when public confidence finally breaks.
To see gold over 10 years trading at a 200 or 300% premium to where it is today.
So today we're at 4,700, more or less. We hit like 5,000. So you're saying the 15,000 gold in 10 years' time?
Yeah, absolutely.
20,000? Yeah.
Neither would surprise me. What you see is that once a trend in motion becomes obvious to people, that it doesn't revert to mean it overshoots. So right. if I'm saying to you that I think gold will maintain its nominal purchasing power, mm-hmm. and maintaining its nominal purchasing power suggests it'll be a $12,000 or $15,000 item, it wouldn't surprise me to see gold overshoot it. Gold did that in the decade of the 70s. Relative to destruction and purchasing power of the U.S. dollar, gold probably should have gone to $450 or $500. Instead, it went to $850. I'm not saying that gold will or won't overshoot. I think it's more likely than not that the nominal price of gold, the U.S. dollar quoted gold price, will reflect the deterioration in the purchasing power of the U.S. dollar, which is to say, an ounce of gold which buys one very nice men's suit today will buy one very nice men's suit 10 years from now.
And that is what gold has done for thousands and thousands of years, whether it was a toga in Roman times to a
Correct.
suit of armor. That is what it does, that it maintains its purchasing power. I'll throw this out at you. Deutsche Bank sees gold at 8,000 by 2031. How does that ring for you?
It makes absolute sense.
Markets dismiss $15,000 gold as fantasy, yet institutional forecasts are already normalizing numbers once considered extreme. What Rick Rule is highlighting is that monetary trends rarely stop at fair value once public panic and institutional repositioning begin feeding each other simultaneously. During the 1970s, gold overshot inflation-adjusted expectations because confidence collapsed faster than policymakers could contain it. Investors waiting for mainstream validation may discover the move is mostly finished before financial media finally calls it rational. Next, Rick Rule unravels the hidden difference between gold becoming more valuable and the dollar becoming dramatically less trusted.
It's a fool's game to name both price and time. But I'm a fool, I'll try. No, I just need to say that I think that gold will mirror the decline in purchasing power of the US dollar, which is the nominal price of gold. It's very important that people understand that that doesn't mean that the real price of gold increases at all. It's interesting, Michelle. I began to save primarily in gold in the year 2000. And as a thought exercise, occasionally, I try to denominate my cost of living, my income in gold. If you do that, if you think in year 2000 terms, when you look at stuff like real estate, priced in gold is cheap. Health insurance priced in gold is cheap. Groceries priced in gold are cheap. It doesn't necessarily mean that the gold price has gone up. What it means is that the denominator, the US dollar, has gone down. And it's important for your audience to at least begin to consider that point of view.
The financial system measures everything in dollars, which hides the fact that the measuring stick itself keeps shrinking. Rick Rule's argument suggests gold is not truly soaring at all. Instead, essential assets priced in gold often become cheaper over long time frames because fiat currencies steadily lose purchasing power. That reframes the entire inflation debate, since rising nominal prices may reflect monetary decay more than genuine economic growth. Investors focused only on dollar gains risk missing the silent erosion happening underneath their reported returns.